If I gave you $50,000 right now, and you could only put it in one place, would you buy property or buy stocks? It sounds like a simple question, but the answer has started arguments at dinner tables, split business partners, and confused some of the smartest investors alive. Real estate people will tell you, land is the only thing they're not making more of. Stock market people will fire back. The S&P 500 has returned 10% a year for almost a century. So who's right? Today, I'm going to settle this. Voters once and for all, we're going to follow two people. Alex puts his money into real estate. Jordan puts hers into stocks. Same starting amount, same timeline. And by the end of this video, you'll know exactly which one came out ahead, and more importantly, which path makes sense for you. Fair warning, the answer is going to surprise you multiple times. Let's go. Let's start with the basics. Since 1928, the S&P 500 has returned an average of about 10% per year. That's almost a century of data, through world wars, recessions, pandemics, and everything in between. If you had invested $10,000 in the year 2000, right before the dot-com crash and the 2008 financial crisis, that money would still be worth over $80,000 today. Even through two of the worst market crashes in modern history, stocks look incredible on paper. Point Jordan. But wait. Let's look at real estate. National US housing prices have appreciated about 4 to 5% per year on average, half of what stocks return. Case closed, right? Not even close. Because here's what that 4 to 5% number is hiding. Real estate has a superpower that stocks don't, and it changes everything. It's called leverage. When you buy stocks, you typically pay the full price. You put in $50,000. You own $50,000 worth of stocks. But when you buy real estate, you put down $50,000 as a 20% down payment, and the bank gives you a mortgage for the rest. You now control a $250,000 property. That's 5 times leverage. Here's where it gets wild. If that property goes up 20% in value, which is $50,000, you just doubled your original investment. 100% return. On paper, the property only went up 20%. But your cash-on-cash return, 100%? Meanwhile, Jordan's stocks went up 20%. That's a 20% return, period. Same appreciation rate. Wildly different outcomes. Point Alex. But before you start shopping for investment properties, leverage is a double-edged sword. If that property drops 20% in value, you don't just lose 20%, you lose your entire down payment and 100% of your cash. Gone. While Jordan's stocks drop 20%, she still has $40,000. She's bruised, not bankrupt. And this is where it gets interesting, because the year 2008 proved exactly how dangerous that sword can be. Let's rewind to the worst financial crisis of our lifetime. In 2008, the stock market lost roughly 50% of its value. Brutal. But the housing market, average home prices dropped 20 to 33%. Some markets, Las Vegas, Phoenix, parts of Florida, crashed over 50%. Now here's the critical difference. Jordan's stock portfolio got crushed, but she didn't sell, she held. And within about 5 years, her portfolio fully recovered and went on to reach all-time highs. The stock market is liquid. It reprices instantly and it bounces back relatively quickly. Alex? His rental property in Arizona lost 40% of its value. His tenants stopped paying. He still owed the bank $200,000 on a property now worth $150,000. He was underwater, and unlike stocks, you can't just hold real estate for free. There's a mortgage payment due every single month. Property taxes, insurance, maintenance, whether or not anyone's paying you rent. Real estate's hidden cost is that it never stops billing you. Point Jordan. But here's what the stock market crowd never mentions. Rental income. Alex doesn't just own a property for appreciation. He collects rent every month. And that rent, after mortgage, taxes and expenses, puts cash directly in his pocket. Month after month, year after year, the average rental yield in the US is around 5 to 8% depending on the market. And here's the beauty, as inflation goes up, rents go up too. Your income rises with the cost of living. That's a built-in inflation hedge that most stock dividends can't match. Speaking of dividends, yes, stocks pay them too. The S&P 500 currently yields about 1.3%. That's not exactly life-changing passive income. Now, Jordan could invest in high dividend stocks more, 3 to 4%. But to generate $2,000 a month from dividends alone, she'd need a portfolio worth over $600,000. Alex can generate that same $2,000 a month from a single well-chosen rental property worth $250,000. For monthly cash flow, real estate wins by a mile. Point, Alex. But wait, there's a catch that Alex doesn't love talking about. Warren Buffett, arguably the greatest investor in history, has said it plainly. Stocks are simpler, more transparent, and don't call you at 2 a.m. because the toilet is broken. And he's not wrong. Real estate is not passive. You're a landlord. You deal with tenants who don't pay, pipes that burst in February, property managers who take 8 to 10% of your rent, vacancies that cost you money every single day the unit sits empty. Jordan, she opens her brokerage app, buys an index fund, closes the app, goes to sleep. Her investment grows while she lives her life. No calls, no contractors, no evictions. The average landlord spends 15 to 20 hours per month managing their properties. That's basically a part-time job, and if you're not willing to put in that time or pay someone else to do it, real estate's returns shrink fast. Point, Jordan. But we haven't talked about the single biggest advantage real estate has over stocks. And it's not what you think. Taxes. This is where real estate absolutely dominates. First, depreciation. The IRS lets you deduct the cost of your building over 27.5 years, even while the property is actually going up in value. It's a phantom deduction. You're writing off losses on an asset that's appreciating. It's the closest thing to a legal cheat code in the tax system. Second, the 1031 exchange. When you sell an investment property, you can roll your profits into a new property and defer the capital gains tax indefinitely. You can chain these exchanges your entire life and never pay capital gains on your real estate. Try doing that with stocks. Third, mortgage interest deduction. The interest you pay on your investment property loan, tax deductible every year. Stocks, you get long-term capital gains rates if you hold for over a year, and you can use retirement accounts for tax-deferred growth. But there's no depreciation, no 1031 exchange, no interest deductions. Real estate's tax advantages are so powerful that many real estate investors pay little to no income tax, legally. Point, Alex. A big point. Okay, so we've gone back and forth. Let me tally this up. Raw returns on paper, stocks win. Leverage amplified returns, real estate wins. Crash resilience and recovery. Stocks win, monthly cash flow. Real estate wins, time and effort required. Stocks win, tax advantages. Real estate wins, it's 3 to 3, dead even. So what's the real answer? Here's the truth that nobody on either side wants to admit. The best investment depends on who you are. Choose stocks if you want simplicity. If you don't have $50,000 for a down payment, if you want to start with $100 and let compound interest do the heavy lifting for decades, if you value liquidity and the ability to sell in seconds and access your money anytime, if you want truly passive growth that doesn't require a single phone call, choose real estate if you want control, if you want to use leverage to multiply your returns, if you want monthly cash flow that pays your bills while you sleep, if you want tax advantages that no stock portfolio can match, and if you're willing to treat it like a business, because that's what it is. The smartest investors, they don't choose one, they use both. Stocks for growth and liquidity, real estate for leverage and cash flow. Together they cover each other's weaknesses. It's not real estate versus stocks. It's real estate and stocks. And that's the answer most people don't want to hear because it's not as satisfying as picking a winner. But money isn't a sport, it's a strategy. And the best strategy uses every tool available. If this video changed how you think about investing, hit subscribe. We make the money game simple. No jargon, no fluff. Just the truth. Money made simple. See you in the next one.